markets outside the U.S., there's two things. One, they have been the sick men of the world. The U.S. is fixed its problems much sooner and posted much stronger growth than the rest of the world and much stronger earnings growth and substantially higher free cash flows. So the U.S. really did lead fundamentally. Now the rest of the world is catching up. And if you look at the pace of growth in the rest of the world, it's typical of early cycle growth, very consumer driven, very robust, and has a number of years in front of it. The U.S. might be late cycle or end of cycle, I don't know, but it's definitely, we've been recovering for a long time. So, for example, in the U.S., the banks are hitting all-time relative highs. Europe is just beginning to fix its banking problem. Asian banks are close to all-time relative lows. So it's really about turning the clock back and seeing the recovery emerge outside of the U.S., and it should provide better earnings growth. It already is providing better earnings growth, stronger free cash flows, dynamic dividend growth, all those things the U.S. enjoyed. We want a portfolio that does well in a rising interest rate environment. Not a disorderly rise in interest rates and a bond collapse, not bond Armageddon, but just a normalization of the yield curve. And that means financial services stocks and be overweight financials and fully weight financials because they're just wonderful assets. The positioning in Europe is what we're talked about, that classic example of on a recovery path, but 3 years or 4 years behind the U.S. So if you put the recovery in Europe chart up against U.S. 5 years ago, it's the same. So Europe is recovering. It's having a very robust and broad recovery. The South is catching up with the North. Stocks are still at a pretty large discount because earnings are growing 14–15%. So if you think about Europe took a big hit when Brexit came out and European stocks were at about a 24% discount to the US, they're at a 22% discount now because earnings are growing. So Europe still has a lot of ways to go to catch up. The UK, on the other hand, having some troubles with Brexit. We don't think they're permanent. The UK market hasn't been doing as well. Some of the big exporters have done quite well, but the domestic demand plays have not. But we think Brexit will be resolved. There'll be a good compromise, and the UK will start growing, maybe catching up with the rest of Europe towards the end of 2018 and into 2019. And there, the opportunity is also in not just the big banks, but also in some of their domestic demand plays. Hotel chains, travel comes back, some of the restaurants, auto-related plays in the UK should do quite well. The key themes in 2018, and very straightforward, are we believe confidence in the global recovery and the synchronized global economic recovery is going to increase by investors, and that's going to cause a normalization of the yield curve and the term premium. There's really a tremendous amount of evidence that most of the world, something like 90% of the world is in recovery and in a very strong recovery. Lots of signs of reflation and inflation picking up. So we just see investors being more convinced that that's sustainable and the yield curve term premium to normalize. And always, the one thing that worries me is that there's so much debt still in the world, particularly in the Western world. I'm not so much worried about Asia and emerging markets, but outside of Asia and emerging markets, the Western world still has massive and greater than before the financial crisis unfunded liabilities. And if we were to have a disorderly move up in interest rates, let's say the bond investors come to the conclusion that the central banks are behind the curve. Let's say there's a 200 basis point rise in the Bund. That could be extremely disruptive. The way we protect ourselves from that is just to effectively limit equity duration and keep quality high. So if you think about high dividends, high dividend growth, quality companies earning significant free cash flows that I'm getting every year and we're getting every year for our clients, that limits the potential downside capture from that disruptive event. And then the financials, rising in a rising interest rate environment helps. So we have some offsets to that, but those are our big concerns.